You've been lied to. Everything you think you know about liquidity is actually wrong. Banks hunting stops, fake. The algorithm does not exist. Liquidity grabs, completely misunderstood. By the end of this video, you will never look at price the same way again, because I'm going to show you what liquidity really is and why the markets don't move the way you were told. Let's start. Now let's start first with what liquidity actually is, okay? Most people have a very basic and a lot of other times a wrong definition of what liquidity is, and this definition here is what almost every legitimate finance book has, or going with this definition, and also based on the Federal Reserve. Now, liquidity and the real definition of it is that it's the ability to buy or sell an asset without causing significant price movement. So it's about causing that significant price movement, and this is the significance of liquidity. Now, there are three core elements that liquidity is based on, and these three are, first of all, the speed of execution, 2, number of market participants, and 3, minimal impact on price. And if you notice, this definition is based on these 3. Now, one thing you will notice from these 3 here, as well as the definition we have, again based on a legitimate finance textbooks, that something is not mentioned here that a lot of people talk about and always relate liquidity to, which is a stop loss. If you notice, there is no stop loss here. There is nothing called swing highs and swing lows. And there's also nothing called liquidity pools in here. They can be related in some way, but not as what most people think. Now, before we go to the definition of what liquidity is actually, which we're going to be covering later, let's keep talking about some other concepts that even more people having a misunderstanding about. And one of these is the imbalance. So let's talk about the impossible imbalance. Now, when people think about imbalance, and then we have the concept of fair value gap, okay, or imbalance. Now, one of the definition that a lot of people say, which is an imbalance, is, let's say in a bullish scenario, only buying pressure, only buying positions, only buyers were in that price action leg or in that specific imbalance, only buying. And everyone says this when price shoots up aggressively. That's what they say, only buying pressure. But there is one simple question here, and anyone teaching you that imbalance, is only buyers or only sellers and price will mitigate that area, that is totally wrong. Now the question is, who are the buyers buying from? If only was buying in there, the buyers buying from who? That's a real question. Before we continue, I've taken everything I've learned over the past 7 years and put it into one place. It's cool. Inside, you will get the full blueprint to finally make it in trading, including the exact strategy I use every day, the edge model. These are some of the trades I've taken with my members. You are welcome to join if you are ready to make the real change in your trading. Let's continue. And if you can find an answer to this, you understand what an imbalance is actually. In order to understand the real meaning of imbalance, we need to understand that every transaction has 2 sides, a buyer and a seller. Every transaction, even if you think in real life, if you want to sell something, there needs to be a buyer for that thing that you're selling. You cannot buy from thin air and you cannot sell to nobody. Now, from this, we understand that for every single buyer, this applies to the market, there is a seller, and that means for every trade, both sides must exist. There is no trade with only a buyer, because you're buying from who, okay? Now, from this, we can come to the real definition of imbalance. And imbalance, the myth of it, and the wrong definition of it is that there are unfilled orders waiting to be mitigated, and a lot of the ICT and smart money concepts saying this. On the other hand, the reality is that of the imbalance is that it's one side of the market that keeps accepting worse prices again and again. So as price was going up, the buyers are accepting prices higher, so worse prices, without waiting for a retracement. So as price goes up, they buy, even in worse prices, creating a temporary pressure that pushes price in one direction until new orders balance it out. So that's the real meaning of imbalance, or the real definition of imbalance. And it's not that there was only buying orders there or only selling orders. No, they were buying and selling, but the buyers were willing to buy on worse prices every time. Now let's get back to liquidity. The everywhere paradox. Liquidity, and that's what most ICT traders will tell you, is that liquidity is at all swing highs and lows. And when you ask about liquidity, they're going to tell you swing highs and swing lows. If you understand the fractality of the market, and if you understand that the market is actually fractal, you will never say this. And let me explain. Now, when we say liquidity is at all swing highs and lows, we understand also that swing points exist everywhere. What does that mean? If we go to the 1 minute chart, there are some swing highs, right? If we go to the 5 minute, 15. Now, even if we use 2 time frames, if I'm looking at 15 minute, we have, for example, a main swing high and main swing low. But if I go to the 1 minute now and still marking these, I'll see that there are a lot of different swing highs and lows inside that range. And that is the proof that liquidity is not that clear. If liquidity is at all swing points on all time frames, because we are saying it's at every high and low, and then it's applicable in all time frames. And that means liquidity is literally everywhere and all the time. Everywhere compared to the swing points, all time frames means all the time. And because of this makes liquidity meaningless, because now the concept of liquidity has no meaning at all, because you cannot use it to differentiate anything because it is in everywhere. So yes, it is true that liquidity is everywhere, but it is useless. Why? It's like telling you in real life that the ocean is made of water. Therefore, every drop is a wave. That is true, but what can I do with it? There is nothing that I can do using that information. Now, talking about the concept of liquidity sweep. Now, we're talking about the liquidity sweep and the stop hunts in specific. Banks don't hunt you. Why? Let's take JP Morgan as an example. Their daily Forex volume can go from 300 to $600 billion every single day. That is the daily volume. Now, your account is only, let's say, $10,000. If it's not less, maybe 5,000, maybe 1,000, okay? And you are 0.000005% of their daily volume. Do you think they do really care about your stop loss? If it's, if you're risking $50 out of this, they don't even register your existence. And sorry to say that, but that's the truth. So do not think that banks hunt your stop loss, because it does not matter. Their real problem is that they need to move massive positions without alerting the market. And it's not to hunt your stop loss. Sometimes your stop loss is going to be at that area. Sometimes it's not going to be. And we're going to be also covering how your brain makes up a lot of different scenarios and play the victim for situations like this. But their problem is that they have a lot of money and they want to move it without making it obvious that banks and institutions are moving money. And that's it. They're not looking for your stop losses. Let's talk about confirmation bias, because that's the thing that a lot of people do that's going to lead to people believing in the concept of liquidity sweeps, because most people needs to find an excuse for their losing trades. And the easiest one is to say liquidity grab, okay? And sorry to say this, but I was even in that situation one time. Whenever I have a losing trade, I say, it's a liquidity grab or there's manipulation. Now the confirmation bias is, let's say, the pattern that you remember, which is liquidity sweep. Price goes above a high, okay, and then reverses sharply. And then you're going to say, oh, see, that's a liquidity grab. And that can be partially true. Let's take as an example, a swing high breaks 10 times, okay, on any chart, any time frame. Reversals after break happens 3 times, continuation maybe 7 times. The problem with your mind is that it remembers the 3 reversals and you forget the 7 times it just keep going. And why is that? That's a confirmation bias. You're just subconsciously looking for the thing that confirms your bias and support the idea that you already have. Now, the thing is, let's consider that your strategy has 60% win rate. That means there is some losing trades and 40% of the trades will lose, okay? And that's just the reality of almost every trading strategy, because there is nothing such as 100% win rate. The problem is when you know that 40% of the time you will lose, that is, the trades that you're going to be taking and they're going to be losers, those are not liquidity grabs, and that's just part of the probability. You're dealing with probability, and that's what trading is all about. But the problem is, instead of accepting normal losses, they're going to consider wins as, oh my god, I'm good and I read the market right and I'm actually good at this. And the losses, they're going to be like, okay, that's a liquidity grab, that's the algorithm hunted me, and all of these things. Okay, and that is the perfect example of ego protection. So if you can notice that liquidity is related to the confirmation bias, and it's related to your ego protection, and it's not even about the liquidity sweep itself. It's about something in you that takes this as an excuse in order to protect yourself and protect your ego. Now, the truth and what you should do. Now we're going to understand what liquidity is, what a liquidity sweep, or the concept or the pattern of liquidity sweep or fake out. What is it in reality? We need to understand that markets don't know price. They discover and put two lines below discover through testing. So as price goes up, it's testing different prices. And as it's going down, it's doing the same. That's based on the auction market theory. So let's take this as an example in order to understand this the best way. Let's say you have a stock or any asset and there is a swing high at $100, the price of $100. So price reached the $100 price, okay? Now that's a swing high. It tests above, so it goes above $100.20, and it's like the market asking, buyers, are you willing to pay more? And if there is no aggressive buyers, that means the sellers overwhelm and then the price reject down, and that's sometime your stop is going to be at the $100.10. For some reason, your strategy tells you that you want to buy there, and then your stop loss got hit during the test, and there was nothing personal there. It was just the nature of the market. It's testing different prices, higher and lower. And sometime you're going to be in that phase of testing and you're going to be stopped out, or sometimes it's going to continue. But the problem is that subconsciously you're only focusing on the stop hands, and you're protecting your ego, and that's it. But it happens in different way. So it's not personal, it's just exploration. So regarding fake out, yes, you can trade fake outs, and it's one of the patterns that you can see based on probability that it works on the chart. So you can see that it works sometimes and it fails sometimes, same as anything else, and it's something that you need to master. And you need to understand before trading fake outs, you need to understand what you're trading. You're trading probability, because sometimes price will displace above a high and sometimes it will reverse after taking a high. It's not conspiracy. There's sometime it's gonna there is a test that's gonna fail, and it's not a hunt, and that is a normal market behavior, and it's not a manipulation. Do not play the victim, okay? It's not against you. The market does not know about you. It just market discovery, market testing new prices. And I do actually teach a lot of strategies about fake outs, so you can check my other videos about fake outs and learn from them. But I never say that this is where banks enter, this is where banks hunt up stop losses of retailers when we're still retail traders. That's the problem. We think that we trade as smart money when we are the most basic form of retail traders. We don't have the tools that they have. All we have is probability, and that's what I trust, and that's what you should trust and trade based on. So the next time you take a loss, what you should do is ask this question: did the market hunt me, or did I just hit my stop loss? If you answer that the market hunt you, then you still need to watch the video again, and you need to stop playing the victim and try to expand your knowledge. And if the answer is, did I just hit my stop loss, that's telling you that you are about to be profitable, because now you're trusting probability and you're trading based on probability, and that's what you should do from first day in trading. So that's it for today's video. If you have any question, leave them in the comment. Make sure to hit the like button, subscribe to the channel, Make sure to check out my community and my classes on H School if you want to trade with me too. That's it, and I will see you next one.